Let's bring in Tim Urbanowicz, Head of Research and Investment Strategy, Innovator ETFs. Thank you for being with us. What kind of feelings are you getting as the people are calling in? The fund flow? Third quarter earnings season is underway. Your thoughts thus far?
Yeah, Nicole, we have a very interesting backdrop for the equity market. You know, on one end of the spectrum, if we continue to see a lot of the economic strength that we've been seeing in recent weeks and in recent months, that's going to force the Fed to keep their foot on the gas. You may see rates higher for longer. You may see additional hikes. And on the other end of the spectrum, if we do get that slowdown that we so desperately need, that's going to weigh on earnings. That's not necessarily going to be good. So you have the equity market that's really caught right in between both of those two scenarios here right now. And the way we're looking at this Q3 earnings season is really almost the calm before the storm. You look at last quarter, we had economic growth, economic activity that held up very well. Consumers were out spending money, they're making money. So we expect results to be fairly strong relative to consensus estimates across the board. But let's not forget, we're starting to see that narrative shift. Consumers are starting to weaken. They've drawn through the excess savings. You're starting to see consumer debt rise at a pretty significant rate when you exclude housing debt. So we need to be prepared for what that looks like. And so that'll weigh on top line growth. And then when we look at margins moving forward, it's really important to note that if we do see the disinflation process continue to work like needs to happen, margins move up with inflation, they move down with inflation as well. So we need to be prepared for that. And that's why we're saying this is really the calm before the storm when it comes to earnings.
So if there's a calm before the storm, at the same time, you still think there could be a pop in markets, right? Where the S&P 500 could see volatility, but then gain.
Yeah, I think it's an interesting time right now too. So if you look historically, look at the past 8 tightening cycles. When the Fed pauses, which we think we're getting very close to that point where we're either at peak in short-term rates or very, very close, that historically has been a very strong time to be invested in the equity market. All the attention has been on inflation, the Fed, when are they going to stop raising rates? And equity investors get excited when they start to see some clarity that, hey, that hike cycle is over. So if you look back at those last 8 cycles that we've seen, equities on average have produced a positive 16 to 17% return in the 12 months following that last hike. And there's only been one instance back in 2000 where we actually saw that 12-month return negative on the S&P 500. And by the way, the majority of those scenarios ended in a hard landing. So hard landing or soft landing, there's a period of time where you need to be invested in equities. And so what we're telling our clients is that really now's the time that we want to be risk aware, but we don't necessarily want to be risk off and just go into the short-term treasuries and call it a day.
Yeah, our last guest was concerned about deflation. He even saw a possible 50% sell-off in equities, the U.S. dollar really losing its value, and was suggesting people run to precious metals for safety. Do these ideas, and I'm not asking you to challenge the guest, but more so for folks who are worried about U.S. debt and that the dollar is weakening, what do you tell them?
Well, I think those are real concerns. I was just last week with a group of advisors out in. Yeah, so just last week was out with a group of advisors out in Phoenix, Arizona, and one of the concerns that everybody has is really where do you go and hide right now? They're looking at their bond allocation, long-term bonds down 50% from the peak in 2020. You're talking about losses that are on par with equity losses throughout the global financial crisis. So that is significant. So we do think you need to look outside of the box. If you look in the ETF market right now, a trend that we are continuing to see just explode across the board is flows into options-based ETFs as a way to manage risk. So we have a lot of clients that are looking at strategies like a POCT, the 15% power buffer ETF, and they're saying, hey, 15% downside buffer against losses over the next 12 months, 15.5% upside if the market rallies. That's a pretty good trade-off given all the headwinds that we're seeing out there right now. But all in all, it is very important to really look outside of the traditional box when it comes to risk management and return management.
Yeah, you talked about the recent earnings peak, on average earnings peak 4 months after the last hike. At the same time, flows into options-based ETFs are exploding. Tell us a little about some of these themes here.
Yeah, so a couple things. When we look at earnings, it's actually very interesting to see how consistent trends have been when it comes to earnings around the Fed hike cycle, and not just peak, but also if you look at when earnings bottom, you look at those last 8 cycles, earnings have bottomed anywhere from 13 to 38 months after that last hike, after the cycle is over. And it really just points to the lagged impact that you see of monetary tightening. You have so many people out there right now that think this time is going to be different. The big question that we want to know is really why that is. So again, it's that risk-aware mindset right now. Generally tends to be a good time to be invested in equities. But we want to make sure that we have some hedge against losses should the market turn south.
Right. And then you have the wild card, the geopolitical tensions. We have actually Biden was just in Israel, coming back. He's going to be asking for more funding for Ukraine, funding for Israel. And you have tensions that have been very high, and oil right now is at $89. I mean, you can call it 90 almost. Where do you think oil could be headed, and or these turn of events, what they could do to our markets?
Yeah, it's a very important question, Nicole. And if you look at this terrible situation that's happening over in Israel right now, it does have the impact to push oil well north of $125 a barrel, especially if you start to see this conflict broaden out, which every day that goes by where we don't see really a resolution, the likelihood that continues to increase. And what's very interesting right now, when you look at that dynamic, is if we have a situation where that does happen, energy prices spike, and it tips the U.S. into a recession like we saw in 1973, like we saw in 1990, that's inflationary in nature. So the Fed may not have all of its tools, policy tools available to cut rates if inflation is running up at the same time. So just more evidence that we need to think outside the box. You can't rely on long duration bonds to provide that protection in the portfolio. You can't rely on those traditional low vol or defensive sectors like utilities due to the interest rate sensitivity. So again, why we're seeing such flows into options-based strategies like buffer ETFs, there's a rhyme and a reason for it, and really all of these risks point to that.
Right, understood. I mean, it's great to see you. Tim Urbanowicz, thank you very much, Innovator ETFs. Thank you for being here.